Hello everyone. Welcome to today's session. So today we are going to discuss about chapter number 14. So what is chapter number 14? Chapter number 14 in your module 2 basically talks about two important is divided into two important units, and it's on the audit of some special units. Okay. When you see chapter number 14, chapter number 14 talks about special features of audit with respect to bank and NBFCs. Okay, so here we will learn something special about the audit of banks and NBFCs. Now, again, as I said, chapter 14 is divided into two categories in your module 2. Okay, chapter 14 is divided into unit 1 and unit 2. Unit 1 is basically special features of audit for the banks, and Unit 2 is of the NBFC. Okay. Now, what we are going to do is we will first start with the Unit 2 and then we'll go to the Unit 1. Now, there are some things, there are some concepts that we need to understand throughout this particular session, okay, which is specific to the NBFC. There are some concepts which are common between the MDFC and the banks. I will, when we will discuss that, I will tell you that these are the common terms. You can also, refer it when we are discussing the NBFC. And there are some specific responsibilities of the auditor with respect to the audit of the NBFC and the reporting of the NBFC that we will discuss. Okay. Before we start the session, before we deep dive into the unit 2, okay, of chapter 14, anyone has any doubt? Any doubt? No? Okay, fine. So let's proceed. Let's start our unit 2 special features of audit of NBFC. Okay. Now, when I talk about NBFC, okay, when I talk about NBFC, so the first and primary question is, what is an NBFC? What is the NBFC? Can anyone tell me? What is the NBFC? What is an NBFC? How it is different from the other entities? Financial institution? Yes, Geeta, very good. Anyone else? What is an NBFC? Only give loans, non-banking financial institution? Yes, yes. Anyone? What is NBFC? Okay, how do you define it? Like, okay, where do you classify an NBFC? Like, let's say for example, if I want to start an NBFC, how will I start? Where will I go? Like the companies are incorporated under the companies that. How the NBFCs are incorporated? Which law is applicable to them? So if I want to start a company, I will go under the Companies Act. What about the NBFC? Which law will be applicable to an NBFC? Section 45 IA of RBI Act. Yes, very good, Sanjay. Very good. Anything else apart from the RBI Act? Which laws or regulations are applicable to NBFC? Yes, very good, Hetal. SEBI laws. Okay. So, here, first of all, we need to understand which laws or regulations are applicable to a NBFC. That means we need to understand the proper application of a standard which talks about laws and regulations. Which was that standard? a standard that talks about laws and regulations. Which was that?
250.
Yes,
Is it
450.
250?
250, sorry. Yeah, 250. Yes. SA 250. Very good, Geeta. Yes. SA 250. Yes, Sanjay. So, when I talk about NBFC, we need to understand which laws or regulations are applicable to that particular NBFC. Reason because then only I will be able to identify. Then only I will be able to identify basically the special features over there. Okay. Chapter 14, Unit 2, NBFC. Now, when I talk about NBFC, uh, some of you already said it is required to be registered under section 45 IA of RBI Act. Okay, great. Yes, 45 IA of RBI Act. But what 45 IA of RBI Act says? Anyone? What is the requirement of 45 IA? Can anyone tell me? We say like okay, 45 IA is applicable to the NBFC, but what actually that section says? What is there in the 45 IA? No? Okay. Let's go and see what 45 IA says of the RBI Act so that we can understand what is the requirement. Like, when we talk about uh, NBFC, like, let's understand then what is an NBFC because then only we will be able to understand the requirement of an NBFC, why NBFC, what is NBFC. So, we have 45, this is RBI Act, okay, and we have 45 IA. Now, what is this 45 IA? 45 IA talks about registration requirements and net on funds. But for whom? Now, if we go to the start of this chapter for in the RBI Act, it talks about provisions relating to the non-banking institutions receiving deposits and financial institutions. So this is chapter 3B. Okay, chapter 3B, which talks about provisions relating to the NBFC, and in that we have a section called 45 IA, which is applicable to the registration requirements. Okay, now what it says that with respect to other laws and regulations whichever are there, no banking financial company shall commence or carry the business of NBFC without obtaining a registration, certificate of registration, which is we call COR. Okay. Obtaining a certificate of registration, having net on funds of 25 lakh rupees or such amount not exceeding 100 crores as may be notified by the bank. When I say bank here, it's a RBI in their official gazette. Okay. So one is they should have the certificate of registration. Number two, their net own funds should be more than 25, less than 100, but in between a amount specified by the bank. Okay. Now, bank may provide different kind of requirement for different kind of NBFCs. Okay. So that is the requirement for the net own funds. That is the requirement for the registration. And there are other sections to section 45 IA subsections, which talks about registration procedure and a lot of things. But there is one important section that we need to understand. And that is what is a net own fund. That section basically we need to understand what is a net own fund. Okay. So, uh, particularly after 7, subsection 7, we have an explanation here in this particular section, which talks about net own funds. There is a definition given for the net own funds. Okay. So, based on this definition, I'll come to the definition and we will discuss the definition. But based on this definition, if your net own funds are within the limit that is being given by the RBI, okay, and if you obtain a certificate of registration, then only you can carry and commence the business of non-banking financial institution. Business of NBFC. Now, what is business of NBFC? So, business of NBFC is a definition, basically. So, that definition is this one. And under section 45I, okay. So, this is section 45I definitions. The first one is 45IA. Remember, there are two different 45IA. This is 45I and bracket A. That's a definition of business of non-banking financial institution. And when I talk about both capital, like 45IA means IA capital both. This one. This is the registration requirement. Two important sections, but both are same. 45I small a, 45I capital A. Okay. So now 45I small a, definition of business of NBFC. What this definition says means carrying on the business of financial institution referred in clause C and includes business of non-banking financial company referred in clause F. That means if you carry on the business which is given in clause C or clause F, you are carrying on the business of MDFC. Okay. Let's see what is clause C. Clause C. Financial institution. Financial institution means any institution which carries on the business or part of its business from the following activities: financing by way of making loans, acquisition of shares and stocks, debentures, securities, or other marketable securities. Okay. Letting or delivering any goods on hire purchase, carrying on any class of insurance business, managing, conducting, supervising chit funds and queries and all those things, collecting or for the purpose of lump sum amounts, monies in lump sums or something similar, and disbursing the award and something like that. A business kind of, where you are collecting lump sum amount and giving the lump sum amount, something like that. So if you do any of the following thing, you are doing the business of financial institution. And there was one F, non-banking finance company. Definition of non-banking finance company, that is 45IF. What it says that means a financial institution which is a company, a non-banking institution which is a company, and which has principal business of receiving deposits under any scheme or arrangement or other things. Such other non-banking institution or class of institution with the prior approval of the central government as notified in the official gazette, means a special section where you specify this particular class of institution as a NBFC. Okay. So that is the non-banking financial company. Non-banking financial company means either a financial institution which is a company, a non-banking institution which is a company, and they should be carrying on the business of a non-banking financial institution. Okay, that we have seen in the definition. But everywhere we are referring one important thing: company. Company. That means NBFC has to be a company. And when I talk about non-banking institution, there's a definition of non-banking institution. Again, it says a company, means a company, corporation, or a cooperative society. So it includes a company. Okay. So in most of the cases, we will see non-banking financial institution being a company, because the definition itself says a company. Okay. So that is the 45IA, 45I definition of the NBFC. So when I talk about the definition of NBFC, means non-banking financial company carry on the business as specified in 45 IA. This is for the business. Now, if you carry on the business as specified in 45 IA plus net own funds, which is 25 to the limit as may be prescribed. See, again, in the section itself, it says that uh, having net on funds of 25 lakh rupees or such other amount not exceeding 100 crore. Now, this part is very important. Or such other amount as may be notified by the bank in official gazette. This or such other amount is given under a specific directions. So RBI issues directions from time to time for the NBFCs. Now, in this case, this such other amount is specified in the scale based regulations. Now, what is this scale based regulations? I'm talking about SPR, scale based regulations. Okay. And we will come to that. What is scale based regulations? We will come to the definition of NOF. But the amount of NOF can be more than 25 lakhs, less than 100 crore, but other such amount which may be specified by the bank. So if there is any amount specified by the RBI, that will be the NOF amount NBFC is required to maintain. So NOF as required by the bank. Yes, Samanathanji.
Sir, I have one question. The net own fund is the criteria whether we have to look at the end of the financial year or during the financial year at any point in time.
We will see. We will see that reason because there are two things in that. When you go for a reporting part as an auditor, okay, over there, what you are required to report, that is more important. And over there, we are required to report few things about net own funds. So we will discuss whether we are required to check during the year as a end of financial year or for 2 years together. Everything will be discussed when we will discuss about the reporting part for the auditor.
Okay, fine, sir. Thank you.
Any other doubts?
No, sir. This particular class, under car also we studied in the class number 12. We have to do the reporting.
Yes, yes. So we have seen in the Caro also something on the 45 IA. We will go that very good correlation basically where we will be seeing that okay how it is being reported in Caro. I will show you a public report, public annual report, and of an NBFC, and we will discuss that how Caro reporting, not only Caro reporting but some other reportings, how they happen. Okay. A lot of things are there with respect to the reporting part. So we will be discussing throughout the session and in the next session also some portion on the reporting part. Okay. Now coming to the question with respect to the net own funds. Remember there was a definition given for the net own funds. Now we need to understand that particular definition. Okay. Yep. Why we need to understand this definition? Reason because you need to understand whether the bank or NBFC, my mistake, whether the NBFC is meeting the requirement of NOF or not, so that you can report as per the requirements of RBI. Whatever we are doing, why we are understanding? Reason because there is a reporting requirement in the picture. We are required to report on 10 different things when we are actually preparing the audit report or when we are delivering a special report with respect to the NBFC to the RBI. Okay. So for that, you can only report once you are aware what is the requirement of the law, what is the requirement of the direction. Okay. Similarly, I can only comment on the net own funds if I understand what are the net own funds and how they are required to be calculated. So, net own funds is aggregate of paid up capital, free reserves, okay, aggregate of paid up capital, free reserves as disclosed in the latest balance sheet of the company, but after deducting the following. So two things we understood. One is the paid up share capital, paid up equity capital rather, plus free reserves. Paid up equity capital and free reserves. Not the preference capital, we are talking about equity capital. Okay. Now, after whatever amount we will receive, we need to deduct the following. What we need to deduct? Accumulated losses, deferred revenue expenditure, other intangible assets. Plus, this is further reduced, and I will come to that, but this is accumulated losses, deferred revenue expenditure, and other intangibles. Accumulated losses, deferred revenue expenditure, and other intangible assets. This is deferred revenue expenditure and other intangible assets. And then whatever amount you get, there is something more also required to be deducted from that. And what is that? Investment in such companies, in shares of its subsidiaries, same group of companies, all other NBFC companies. Okay. All under NBFC companies. If you have made in the, if you have made an investment in shares of subsidiary, same group companies or other NBFCs, you are required to reduce the amount. Reason because this particular reduction is on the grounds that you should not be using same money twice. That, okay, I brought in the money. Okay, the money was invested in my company. Then I provided the investment to my subsidiary as in capital contribution, and then subsidiary to subsidiary whatsoever. So it should not happen that the money which I'm counting in my net own funds should also be counted in someone else's net own funds. Okay. So to prevent that, this kind of deduction was introduced. So less investment in shares. Investment in shares. Now these shares basically are of subsidiary, same group company and NBFC, not any other company. Either it should be a subsidiary, it should be a company in the same group, or all other NBFC. But if it is not a subsidiary, not in the same group, not an NBFC, I'm not required to count it here. So excluding not subsidiary, not same group, and not NBFC company. If that is the case, do not reduce the amount as of now. Do not deduct. Okay. Now, that was with respect to the shares. That was with respect to the shares. But now we need to understand one more kind of deduction. This was deduction with respect to the shares. Now we will see the deduction with respect to the debentures. So if there is a book value of debentures, bonds, outstanding loans and advances, deposits, with or made to subsidiary, same group companies, then in that case, to the extent of such amount exceeding 10%, you are required to deduct that amount. To the extent such amount exceeds the 10% of above. Now, what is above? This one, this A1 that we have received. Okay. So after removing, you need to first calculate 10% of this. Then, once you calculate this 10%, let's say for time being, I will call this X amount and this I will call as a Y amount. Okay. Now, what they are saying is book value, debentures, everything to the extent amount exceeds 10%. Okay. Of this, you are required to deduct. That additional amount you are required to deduct. Further reduced by the component representing this and this. So I will remove the amount here, bonds. Let's say the amount of bond is 100. That has to be 100 minus 10% of Y amount. Okay. That much amount I will reduce. 10% of Y. What is Y? Y is an amount that we have received after deducting the accumulated losses, deferred revenue expenditure, and other intangibles. This one. Okay. So bonds, whatever amounts of bonds are there for the subsidiary, for the same group of companies, and we are talking about the book value, reduce it by the 10% of the amount before giving such deductions, that is the Y amount, and in excess of the Y amount, 10% of Y amount, in excess of 10% of the Y amount, whatever amount comes, reduce it. For example, let's say we will see the net own funds example. Example, let's say paid up share capital or paid up equity capital rather. 100 free reserves, let's say 50, total comes to 150. Now, then we are required to reduce accumulated losses. Let's say we don't have any accumulated losses. Deferred revenue expenditure. Let's say we have deferred revenue expenditure of 10. Other intangibles. Let's say we have other intangibles of 40. What amount we are left with? 10. Hypothetical. Everything is hypothetical. Okay. Let's say investment was made in shares in same group companies or subsidiaries or whatsoever, NBFC you're talking about. Let's say 30. So I'll reduce that. Now we have a, let's say, bond or debentures. Bonds or debentures. How much they are issued? Let's say they are issued 40 book value. But am I required to reduce book value? Answer is no. What I'm required to reduce is book value minus 10% of the Y amount. This is the X amount. This is the Y amount. Now 10% of Y amount, I am in excess of that, whatever is there, I'm required to reduce. So I'll reduce the 10% of Y out of this. So less 10% of 100. It will be 10 basically. So once you will reduce 10 rupees from 40, whatever amount comes, let's say this will be 30. You are required to reduce it. And then the amount that you will receive at last, 100 minus 30 and 30, it is 40 that is remaining, is your net owned funds. Clear? Example of net owned funds calculation. Clear? Any doubt with this? Any doubt? What amount was reduced? I hope you guys now understand that.
Sir, here, what is that other intangible asset means, sir? Is it?
So whatever intangible assets you have in the company.
Okay, in totality.
Yep.
Okay, 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 sir.
Any other doubts? What is the
So,
logic for debentures? Yeah. Yes. Yes.
so can you give another example or explain this example again? So,
Sure. Definitely. So, what was the example or how it works is when we are calculating the net own funds. So, equity capital, first you need to add the equity capital of 100. Then you need to add the free reserves, whichever free reserves are there. Okay. And the amount that you will receive after adding the paid up equity capital and the free reserve is the first step, amount X. Then you need to reduce the accumulated losses, the deferred revenue expenditure, and other intangible asset. Okay. In our example, we said, let's assume we don't have any other accumulated losses, but we have the deferred revenue expenditure and other intangibles. So after reducing this 50 from this 150 X amount, you will get a Y amount. Okay.
yes,
You, yes.
yes, sir. I understand this much.
Now, once you receive this Y amount, you need to reduce the amount that you have invested in shares of subsidiary, same group companies, and all other NBFCs. That is the one amount, investment in shares. When I talk about bonds, that's where the complications start. With respect to the bonds, when we have to deduct the amount with respect to the investment in bonds of the subsidiaries and same group companies. Remember one thing here, all other NBFCs are not required to be counted for bonds and deduction. Over there, we had in shares, we had all other NBFCs, but here we don't have all other NBFCs. So only the bonds made to or deposit with subsidiaries, companies in same group, those are only required to be counted. Their book value is required to be counted. But to the extent such amount exceeds this Y amount by 10%. So this Y amount, the 10% of this is 10. Okay. Let's say bond book value is 40. Debentures book value is 40, which is invested in same group companies or subsidiaries. So out of this 40, I will reduce the 10% of this. 10% of this 100. That will be 10. So once I will reduce 10 from this, I will be remaining, I will be, having 30 is the amount that I need to reduce to get the net own funds. So whatever book value is there, you need to reduce 10% of the Y, and whatever amount you get, that is the amount you need to deduct from the entire calculation. Clear?
Yes, sir. Yes, sir. Clear.
Any other doubts? Any other doubts?
Sorry, is that only respected to the same group company to be done or different types? See, outsider also we need to consider this investment in share.
Share is same group, subsidiary, and all other NBFCs. But if the company is not a same group, not a subsidiary, not an NBFC, not required to be counted.
Okay, which means only the outsider.
Yeah, kind of. Okay. Any doubt? Okay. If no doubts, then there is something I want to discuss further. Okay. There is something which is there, which are the rules. Now, this is basically, you can say, the act what we are discussing. But is there anything beyond the act? Is there anything or any regulation beyond the act? And answer is yes. Beyond the act, we have scale-based regulations. Now, what are these scale-based regulations? Even scale-based regulations also has provided definition of net own funds and net own funds. Yes. So there is a definition of own funds which is given in the scale-based regulation. Okay. And over there, if you see the scale-based regulations, they are applicable to all the NBFCs. There is some specific scenarios also that we will discuss to whom it is not applicable or where it is not applicable, but it is applicable to a lot of NBFCs already. Okay, and there is already a requirement given of the own funds. What is own funds, and a definition is given. But let's understand that in a while, we will go to the skill based regulation for detailed understanding. Now, to understand the NBFC, we have to understand the classification of the NBFC. This is just the act part that we have discussed in the NBFC. This is just a part of the law, one law that we have discussed. This is nothing but your RBI Act. Okay. Laws and regulation. This is nothing but the RBI Act that we are talking about. But we need to understand what are the classification of the NBFC. Reason because based on that, we will now understand what are the laws, further laws and regulations which are applicable to an NBFC. So can anyone tell me what different types of NBFCs are there? What different type of NBFCs are there? Anyone?
Yes, sir. There are infrastructure finance company, core investment company, and like a non-banking financial company, microfinance, investment and credit company, like non-banking financial company, and also the operating financial holding company, asset finance
Hmm.
company, investment company, loan company, mortgage guarantee company, like that. There are so many type of NPCFs are there, sir.
Okay, okay, very good. Some of you have given the answer is systematically important, non-systematically important, giving deposits, accepting deposits. See, the classification of systematically and non-systematically important one is already gone. That is no longer present. There is no such classification nowadays available, systematically important or non-deposit accepting systematically important, something like that. Those were the old classification. That is gone. So there are two type of classifications that we are going to discuss. Type of classification. Okay. So the first type of classification is type of function based classification. Now, what is function based classification? Function-based classification is where NBFCs are classified based on what they are doing. What they are doing. For example, it could be investment credit company, it could be infrastructure company, infrastructure finance company, it could be core investment company. Now, that is given on your study material, page number 14.88. This is nothing but you can say function wise classification. Okay.
Yes, yes. So
ICC.
sometimes it will talk about layer of the companies. Layer also will be there, sir, I believe. The core company, core investment company. If there is a more than two layer, then we have to report under Caro as well.
Yes.
Yeah, as
We
per
will come on to
Cosmo.
that also, reporting part. Yes, very good. Absolutely correct. Yep. So CIC, then infrastructure debt fund, MFI, microfinance, NBSC factors, NBSC, NOFSC, like non-operative finance holding company. Then there are multiple. There are various. It's not something that these are just examples I'm talking about. If you go to the RBI website, you can see a different regulations, different directions applicable. For example, asset reconstruction companies. Okay. Then there are multiple different kind of NBFCs which are available right now in existence. Their regulations are also there. Then you have a microfinance loans. You have various different kind of NBFCs, and we will see that. We will not dwell into all the laws of regulations which are there for the NBFC, but we will see some classifications also. That is one function wise classification. What they do actually on the ground, that is a one type of classification. Now, second type of classification is very important. That's where our law again comes into the picture in much more detailed way. Second is scale based classification. Scale, sorry, scale based classification. Why this is important? Reason because this classification, scale based classification, the higher the scale, the higher the regulations will be applicable. The higher the regulated entity it will be. That's why we have a scale involved now. Earlier, we used to call systematically important, uh, systematically important non-deposit taking, deposit taking. Remember, non-systematically important. Earlier, there was these type of classification that are done away, old, gone. Now we have a scale-based classification. Scale-based classification are divided into four scales as per the scale-based regulations. Now these classifications work as per SBR. That's a scale-based regulation. That's the main and key NBFC regulation which is applicable as on today. Okay, which talks about a lot of things. So when I talk about NBFC directions, important directions issued by RBI, which is amended from time to time, it's nothing but the scale based regulations direction. We call it scale based regulations, but these are the directions 2023 direction. Okay. Now, this scale based directions or scale based regulations divide NBFC into four layers. Okay. Divide NBFC into four important layers. Those four important layers are number one, NBFC base layer, BL. Second is NBFC middle layer, ML. NBFC upper layer, that is UL. And then there is an NBFC top layer, TL. These are the four different layers under which NBFCs are then classified. Either they are classified based on the functions or they are put. So you can understand these are the four big buckets: base layer, middle layer, upper layer, and the top layer. These are the four different buckets. What includes in the base layer? Base layer includes non-deposit taking below asset size 1000 CR, NBFC performing following activities and performing following activities: peer-to-peer lending, P2P, NBFC aggregator, account aggregator, NOFHC, or NBFC not availing public funds and not having any customer interface. If this is the NBFC, then this NBFC will go into the base layer. Important. Remember this. Non-deposit taking, having asset size below 1000 CR, and the functions. Second category, middle layer. What middle layer includes? Middle layer includes having asset size, okay, more than 1000 CR and not deposit accepting, because less than 1000 already gone to base layer, more than 1000 now will come to middle layer. All deposit taking, irrespective of the asset size, and following activities, which can be primary dealer, infrastructure debt fund, CIC, core investment company, sorry, housing finance company, NBFC, infrastructure finance company. So all these things will fall now into the middle layer. Okay. Remember, all deposit taking and non-deposit taking having asset size of 1000 crore and above, and the functions. So there are two type of categorization in the layer system. One based on the asset side, and second is based on the function. So function plus asset size. Function plus asset size. Third, upper layer. Now what is included in the upper layer? Upper layer basically are those NBFCs where RBI wants to have enhanced regulation. So they will classify certain NBFCs into the upper layer based on the methodology, based on the scoring methodology. Okay, based on the scoring methodology, they will classify certain NBFCs as an upper layer NBFCs. And then those NBFCs are required to follow the directions which are given to the upper layer NBFCs. Basically, it will be the top 10 eligible NBFCs in terms of their asset size will be there in the upper layer. So top 10 NBFCs in India based on the asset size will usually go into the upper layer. But there is a scoring methodology, okay, which will come into the top 10, whether they want to shift or not. So there is a scoring methodology given. And the last category then, which is the top layer, fourth one. This category is required to remain idle, empty. It will be populated if there is a substantial increase in the potential systemic risk from the specific NBFC. Then only that particular NBFC will be shifted to the upper layer. Okay, then only that NBFC will be shifted to the upper layer. Now, a simple question to everyone. What is systemic risk? When I talk about this particular term, okay, systemic risk, what is that? Like substantial increase in the potential systemic risk. What is this? What is this risk? Can anyone tell me? Anyone? What is this risk means? What is this risk? Anyone? No? Okay, let me tell you. Oh, yeah. Market risk, okay. Economic risk, no. Basically, this risk is when, let's say, a risk that, okay, if a NBFC fails, it will take multiple financial institutions or system down with that particular NBFC. If a NBFC crashes, then because of that, the entire system might be crashed because that NBFC is of such a big nature or interconnected or something like that. So a market crash with the crash of that particular NBFC is, you can say, a level of systemic risk. Now, when there's an increase in the potential systemic risk, that NBFC will be transferred to the top layer from the upper layer. Okay, so this transfers happen from the upper to top layer in special case scenario. Otherwise, top layer will remain empty. Clear?
Yes, sir. We also studied in AFM the systematic risk and unsystematic risk. Unsystematic risk is pertaining to the particular company. It's a systematic risk is overall effect that particular NBFC group.
Yes, very good. So now the question comes is that why we are referring these layers? What is the use of these layers? What is the purpose of this layer? The purpose of this layer is understanding the regulations applicable. Now, when I say scale based regulations, that means based on the scale, base layer, upper layer, top layer, the or middle layer, the regulations will apply to them. So, for example, section 2 of these directions specify the regulations which are applicable to the base layer. Similarly, we have section 3 which specifies regulations applicable to the middle layer. So if your NBFC falls under a particular layer, then in that case, okay, that regulation will be applicable, not the entire. So you don't have one straight regulations for all the NBFCs. No. So regulations applicable to the NBFC now will depend upon the scale. Lower the NBFC, lower the regulations, higher the NBFC, higher the regulations. That's why they are known as a scale-based regulations. But having said that, there are few things which are common across all the layers. And we will understand with respect to the base layer. See, if something is applicable to the base layer, then that the concept will be applicable to the middle and the top layer or the upper layer, but with some modified way. It's not something that I am talking about net owned funds in the base layer and suddenly I go paid up share capital in middle layer. No, that will not be the case. So whatever we are talking about in the base layer, only the limit might change with respect to the middle layer and the upper layer. Yes. So a question like also can come on this layer related system on in exam. So this is very important for us to understand about these layers.
Yes, sir. We have seen a couple of questions asked in the MCQ portion, particularly in the question they will describe the story. Okay, this particular NPSC, which layer it will come? It will give the 4 options: base, middle, upper, top, like that. It's very important.
Yeah.
In 6 months, 3 MCQ came. Actually, I was visited this.
Yeah. So very important part where we need to understand about this layering system. Okay. Now that is one of the scenario with respect to the layer part. One of the scenario with respect to the layer part. Another thing is few definitions. Before we deep dive into the regulations as per the layers, we need to understand few definitions because these are the important definitions that will be used throughout these regulations. Now we have only seen a definition of some non-banking financial institution, non-banking company, business of non-banking company, or net owned funds. We have not seen any other definition as of now, but now we need to see that those definitions so that whenever we will discuss that term, we will be able to understand that what it means. For example, NBSC factor means the NBSC defined in clause F of 45I of RBI Act, which has a principal business mentioned in paragraph 123 of these directions and been granted a certificate of registration under Factoring Regulations Act. ICC means a financial institution carrying on its principal business as a asset finance, providing finance whether by making loans or advances. Similarly, you have definitions of IFC, MFI, okay. Different kind of NBSC's definition is given. Plus, we have an important definition that we need to look into. That is own funds. Own funds. I'm not talking about net own funds. I'm talking about own funds. Own funds means paid up equity capital, preference shares, convertible to the equity, free reserves, balance in share premium account, capital reserves, okay, representing surplus arising out of sale of proceeds of assets as reduced by accumulated losses, book value of intangible, and deferred revenue expenditure. Remember the amount why we were talking about? That is explained in much more detail. Okay, in Act, we only had paid up equity capital and preference reserve. But now they have clarified that preference shares, which are compulsory convertible into equity, count that also. So this is additional. Balance in share premium, count as a free reserve. Capital reserve, count as a free reserve, excluding revaluation of asset. Excluding reserves created by revaluation of asset. If that is the case, do not count. Otherwise, these are the additional ones compared to the Act. These are the additional compared to the Act. But the point remains the same that we were talking about paid up equity capital. We were talking about free reserves. Now also preference shares which are compulsory convertible into equity, future equity, you are counting. These balance and share premium and capital reserve are counted as a free reserve. Revaluation reserve or revaluation of asset and reserve created from that, they are not the free reserves. Then that has been reduced by the accumulated losses, book value of intangible, other intangible assets. Sorry. And deferred revenue expenditure.
Yeah,
But
here
there is
here the investment in share and bonds is not coming.
that's why I'm talking about own funds, not the net own funds. I'm getting
Okay.
the own funds and then I'm reducing something more to get the net own funds. Here it is only owned funds. The term is different. Clear? And if you see the Act, it was net own funds. Because till here, before reducing this, till this particular point, it is the own funds. Once you remove the investment, you get the net own funds. So the amount why we are talking about is the own funds. Okay. So we are talking about own funds. But there is one important amendment, okay, or a clarification, I would say, which was issued in March 25. That was that right to use is not required to be deducted. Okay, right to use of asset. If it is based on the tangible asset, it is not required to be deducted because there was a confusion. Should we include right to use of asset as a other intangibles? So this right to use coming from tangible is not required to be deducted or not required to be included. Not to be included in other intangible asset, provided the underlying asset for the right to use shall be as tangible asset, and that is as per the Ind AS 116 leases. Clear? Any doubt?
Yes, sir. Clear, sir.
Okay. Now we are going to understand one more important concept with respect to the capital only. We discussed own funds. We discussed net own funds. Now we will discuss tier 1 capital for NBFC, except for BL. Why? Because in BL's case, we will see what is different. We will see in some time with respect to the BL. Okay. But except for BL, what is tier 1 capital? Tier 1 capital is nothing but your net own funds. You reduce by the investment in shares in other NBFCs. Okay. And in shares, in debentures, bonds, loans, advances outstanding in subsidiaries and group companies in same group, exceeding 10% of the own funds. That's a tier 1 capital. When you take a net own funds, sorry, you take a own funds and you reduce investment in shares of other NBFCs and in shares, debenture, bonds, and everything within the same group, exceeding 10% of the net own funds. Okay, so this investment part exceeding 10% of own funds. So whatever investment we are talking about, so investment okay, in minus own funds into 10%. That is the first thing we need to minus from the own funds. Investment minus own funds into 10%. Second thing is perpetual debt instruments issued by a NBFC exceeding, which does not exceed 50% of the tier 1 capital. Perpetual debt instrument. Okay. We have to reduce perpetual debt instruments, PDI, which does not exceed 15% of the tier 1 capital. So once you will reduce this minus 15% of tier 1 capital. Okay. Tier 1 capital is basically, after giving this impact, whatever we are calculating here from this. So that will be, 15% of that is required to be taken as your tier 1 capital in total. So 15% of, I will say, let's say this is T1 amount. So perpetual debt instrument does not exceed 15% of T1 amount. If you take these two things, you will get your tier 1 capital. Clear? So there are two things involved into the tier one capital. One is the own funds, which is reduced by the investment in shares, okay, of other NBFCs and investment in shares, debentures with subsidiaries of same group companies exceeding, like, in aggregate 10% of the own funds that you have to reduce. Okay, own funds minus that. Plus perpetual debt instruments issued by NBFC where it does not exceed, to the extent, does not exceed 15% of the tier one capital of
Sir,
such
here,
company.
sir, here the perpetual debt instrument is issued to the group company or outsider, sir?
No, perpetual debt instrument issued as per the regulations, basically. Now, when I talk about regulations, I would say, specifies to whom you can issue. So it's not to, you can to issue to everyone. For example, let's say debentures. In company sector also, there is a limitation that debentures, you cannot issue irredeemable debentures. But when I talk about perpetual debt instrument, that is perpetual, that will never get redeemed. That will
Yeah.
never be, kind of written back.
Yeah, perpetual means it's upon liquidation only they are eligible.
Yeah. Yes.
Before that, it
Yes.
is not redeemable. But
So
what I'm asking, whether the perpetual debt instrument is issued to the closely, which means the group company or outsider,
to
which one
anyone,
to be taken?
include to anyone, both.
See, on the first case is very clear, sir, that the debenture, bond, and other things, the loans and hire purchase is issued to the within the group. Only for that only we are going to deduct. For outsider, we are not going to do anything.
Yes, yes. That's why I'm saying to anyone. To anyone. It is there is no classification there.
Okay, fine, sir. Thank you.
Huh. So perpetual debt instruments, basically, I'll simplify the formula for you guys. Okay.
Yes, sir. Actually, I'm sorry. I'm first time studying this. Other chapter I have studied few times, but this is the first time I'm studying. That is what more question from my side.
Yeah. Okay. So let me simplify the formula for you guys again. Let me do one thing. Let me remove it from here. I'll simplify the formula for you guys in here. T1 capital. Okay. So T1 capital was sum of two things. Now, when I talk about sum of two things, there are two items that are required to be added to get the T1 capital. One is own funds. Okay, I'm required to add own funds, and then I'm required to add perpetual debt instruments. Okay, in order to, add these things, once I'll add these things, I'll get the tier one capital. If I add these two things, I'll get the tier one capital. This is a simple shortcut. But before adding these amounts, I am required to reduce something from these amounts. Before adding the net own funds, I'm required to reduce, that is less, investment in shares, in debentures, in bonds. Investment in shares, debentures, bonds. Now, when I talk about with respect to the shares, it is in the same like other NBFCs, subsidiaries, and companies. When I talk about bonds, it's only subsidiaries and same group companies. Okay, that is aggregating or exceeding 10%, 10% of the own funds. So investment less 10% of owned funds. If you minus this amount from the own funds, that resultant amount, let's say reduced own funds, for example, hypothetical example, reduced own funds. is the amount that you need to take up for the tier 1 capital. Reduced owned funds is the amount you are required to take for the tier 1 capital. Then second amount is the perpetual debt instrument. Perpetual debt instrument. Now, how much I can allow? That how much amount I am required to take for the perpetual debt instrument? I am only required to debt to the extent of 15% of the tier 1 capital of previous year. Okay. So whatever tier 1 capital amount was there of previous accounting year, okay, to the extent of 15% means I cannot go beyond 15%. So perpetual debt instruments or 15%. This is the kind of restriction you can say of tier 1 capital of previous year. Whichever is lower. If your 15% is lower, you are always be restricted to that. If your perpetual debt instrument amount is lower, you will go for that. But I cannot exceed beyond 15% of tier 1 capital of previous year. So that's why it says does not exceed, to the extent it does not exceed 15%, whichever is lower. That amount, basically, so the lower amount, lower of below, these two amounts together will make your tier 1 capital. This is the definition basically and the formula to calculate the tier 1 capital. Clear?
Yes, sir. Clear, sir. This particular calculation asked in few times, sir, in exam also. I have seen it.
Yes.
It's very important, actually.
Okay. Now, second thing is that remember we were talking about it is not applicable to the base layer. Why? Reason because base layers are not eligible to include perpetual debt instrument. Base layer is not required or it's not allowed to include perpetual debt instrument in the tier 1 capital. So for base layer, in this formula, for base layer, it ends over here. Tier 1 capital for base layer is this one. That's it. They will not add lower of perpetual debt instrument. I'll just border it out.
Which means that for PDI, not applicable for base layer.
No, yes, PDI is not applicable for the base layer.
Sir, one more doubt. See, if the company is NBSC started in the current year, then the previous year only we need to check that limit 15%. If it is a current year only is opened, then how we can check the tier 1 in this case, sir? Can we take the full perpetual debt instrument?
No, not full perpetual debt instrument. In that case, there will be no allowance. So if there is no tier 1 capital of the previous year, you will take 0 for that. There will be no allowance for the tier 1 capital or perpetual debt instrument.
Okay, in that case, it will be 0 for that.
0, yes.
Okay.
So base layer tier 1 only own funds lets that amount. For the rest of the categories, we have perpetual debt instrument, but perpetual debt instrument is not applicable to the tier 1.
Okay, if it is a first year.
No, any year. Base layer, they are not allowed to include perpetual debt instrument. We get any year.
Okay, sir. I am asking, other than the base layer, if the NBSC started this year only, say example in 2025 it is started.
First year, yes, there will be no PDI.
First year, even though the PDI is issued, we will not consider that.
Yeah.
Okay. That's what I'm asking. Thank you, sir.
So base layer, not eligible to include perpetual debt instrument in tier 1. Clear tier 1 capital for NBFC. Any doubt?
I'm clear, sir.
Okay. That was a tier 1 capital. Now there is something called tier 2 capital. Okay. Tier 2 capital. What is tier 2 capital? This is nothing but the extension of the tier 1. So you can say whatever we have calculated in tier 1, we extend that. We increase that amount, or we, go beyond that to get the tier 2 capital. So the things which are not counted in the tier 1 now will be counted over here. So whatever was left out in the tier 1 will be counted in tier 2. For example, preference shares other than those which are compulsory convertible means optional convertible preference shares. So compulsory already taken in the tier 1. Now these are the optionally converted preference share. OCPS. Okay. Revaluation reserves discounted at the 55%. So revaluation reserve discounted rate of 55%. Reval reserve at 55%. General provisions, including standard asset, loss reserves, not attributable to the diminishing value, all these things. Okay. To the extent which is allowed as per the risk weighted assets. So general provisions, basically, we make the provisions in the company. So provision for loss assets, provision for standard assets, a provision for loss and reduction in value of any asset or investment. That is the one. Okay, provision, general provisions. Then we have a hybrid debt capital instrument. Hybrid means they are also debt, they are also capital. For example, convertible bonds, convertible debentures.
Yes, sir. Hybrid means we have studied in the financial instrument
Yeah.
also. In that, the derivative combination, non-derivative portion
Yes.
will be there. Is in it. That is called hybrid.
Yeah. Then we are talking about subordinate debt. Then we are talking about perpetual debt instrument in excess of what qualifies for tier 1 means whatever was left out in the tier 1, like sorry, whatever was not allowed in the tier 1, I allowed only to the extent of, let's say, for the 15% of tier 1 capital, perpetual debt instrument. Let's say, for example, if this was perpetual debt was, let's say, 100, and this was, let's say, 50, or let's say 40, 10-15% of previous year tier 1 capital. So the amount that will be allowed will be 40, lower of both 100 or 40. So what I allowed only 40 out of 100. Rest 60 will go to my tier 2 capital. Okay. Rest will go to tier 2 capital. So that means your perpetual debt instrument amount is perpetual debt instrument less amount allowed in tier 1. If there is an amount which is allowed in the tier 1, you need to remove from total perpetual debt instrument amount, and that will be the amount which will be allowed in tier 2. So you take the tier 1 amount which is allowed over there in the name of perpetual debt instrument, reduce it from the total perpetual debt instrument amount, and whatever left will be allowed in tier 2. Clear? That is your tier 2 capital. Preference shares, optionally convertible, revaluation reserve at discounted rate of 55%, at the rate 55%, general provisions to the extent 1 and 1/4% of risk weightage assets, hybrid debt capital instrument, subordinate debt, perpetual debt in excess of what was allowed in the tier 1 will be counted in the tier 2. So, to summarize for you guys, tier 2 capital optionally convertible preference shares, subordinate debt, revaluation, reserve at the rate 55%, general provisions, then perpetual debt instrument to the extent disallowed in tier 1 capital. That is your tier 2 capital. Any doubt?
Okay, which means whatever is disallowed to the extent of 15% only we accepted. The remaining portion we will allow here.
Yes, absolutely. Any doubt? See, that is the definition of tier 1 capital. That is the definition of tier 2 capital. That was the definition of own funds. And why we are reading this? Why we are going into the formulas? Why we are understanding the formulas? The reason because as an auditor, we are required to report whether the required level of tier 1, tier 2 capital was met or not. And what I'll do is, after the break, we'll take a break for now for 10 minutes. After the break, we will go and see how these things are reported. Then we will realize, okay, why we are required to calculate, understand these terms. Okay. So let's take a quick 10-minute break. After the break, we'll gather back and we'll go and deep dive into the reporting part, some of the reporting part, that how these terms are reported.
Sir, I have
Okay.
only one doubt, sir. I have one doubt. Sir. In the previous slide, that base layer, that PD is not applicable, but then the tier 2 is not applicable for the base layer.
Yes, because see, for the base layer, again, base layer are not eligible to include perpetual debt instruments. So
Yeah,
if you remove this point, then it will be tier 2 for the base layer.
Okay, which means the tier 2 is also is applicable for base layer.
Yes, yes. So everything is applicable. So whatever terms we are discussing, this is the definition applicable for all. So
See,
PDI.
go back to the previous slide only. In that slide only, I have doubt.
PDI not applicable.
Yeah. For base layer.
Yeah. NBSC base layer. This one, yes.
Okay, yeah, here on the 5.1.35, it's a tier 2 capital for NBSC except NBSC for BL, which means the tier 2 itself is not applicable for BL.
No. It's not like that.
Okay, only is except the below item.
Yeah, so because this note is given.
Only this alone is not applicable.
Yes.
Oh, okay. Okay, sir. I wrongly conceived that this entire tier 2 itself is not applicable.
No. So even these similar wordings are there in the tier 1 also, except NBFC.
Oh, okay.
So otherwise, both will not be applicable. There will be no applicable requirement for the capital then.
Okay. My
Yeah.
interpretation is not in line with the standard. Okay, sir, I got it. Learning.
Okay. So let's do one thing. Let's take a quick 10-minute break. After the break, we'll gather back and we will carry out reporting. We'll see some of the reporting part, and then based on that, we will go further and deep dive into the requirement of the scale-based regulation. Let's take a break. discussion on the scale-based regulation that we were doing. Before I proceed and before we more, deep dive into the scale-based regulations, I want to discuss a few things about the reporting part so that we can understand what is the requirement for the reporting, why it is important, and what is the purpose of reporting. See, basically, what happens is that all these things that we are understanding are necessary for the purpose of reporting, and we should be aware like where all these things will be reported. Okay, so I will show you a particular financial statements which are available in the public domain. Basically, these are of 24. Again, 25 will also be the same, will not be a much difference. So I'm using a reference for the 24 only. But these financial statements, these annual reports will show you how the auditor is required to report on these critical matters or these critical things that we are understanding. Again, this is available in the public domain. It's so please do not focus on the name of the entity. This is nothing but the independent auditor's report. If you see, this is the independent auditor's report, okay, of a particular NBFC. Of a particular NBFC. Now, this is on the standalone financial statement. Why we are, looking this particular report? Reason because here we will see some of the key and important aspects with respect to the NBFC part. Just a glimpse. We will not deep dive as of now on the reporting part, but for you guys, just a glimpse, I will show you something how matters related to the NBFC are reported. How specific matters related to the NBFC laws and regulations are reported so that you guys can understand like what is the actual reporting requirement. Just a minute. Stuck. Yeah. See, this is a particular section, notes to accounts, okay, which is with respect to the capital. This is with respect to the capital, where we are required to report on the tier 1, tier 2 capital. See this tier 1 capital, tier 2 capital, total tier 1, tier 2 capital. So this is tier 1, tier 2, total tier 1, tier 2, 2024, 2023. Now, this is part of the financial statements. These are the part of financial statements. Means that you have to audit them. You have to see whether this is correct or not. Not only this part, not only the capital part, but there is additional disclosures with respect to the other things, with respect to the NBFC related requirements or NBFC related norms or regulations. For example, I will show you. Just a minute. See this one. Disclosures as required by Master Direction, Reserve Bank of India, NBFC, scale-based regulations, where we are giving Tier 1 capital, CRAR, Tier 1 capital, CRAR, Tier 2 capital, percentage. So we are providing percentage of CRAR, Tier 1 capital, Tier 2 capital, 21, 1, This is something, we are required to audit. And as per, see, what is CRAR? We will see. This is nothing but a capital adequacy ratio. Okay. So we will look into that, how it is required to be calculated. But these percentages are given in the regulation. As an auditor, we are required to see whether these percentages are being met by the company or not. See, discounted value of Tier 2 bonds considered for the purpose of Tier 2 capital. Discounted value. Then you have a lot of other things. This is again part of the NBFC regulation, investment part, disclosures. Again, all these are disclosures which are given as per the NBFC norms. This everything. For example, this is exposure related. All these disclosures are given as per the NBFC regulations. See, continued still. These all things are given as per the NBFC regulations. All these disclosures. And as an auditor, if if this is required to be given as a part of my financial statement, then as an auditor, I should be aware about this, that what is required to be disclosed in the financial statement or not. Because for the NBFC, this is the financial reporting framework, applicable financial reporting framework, other than the Ind AS and all the requirements of the Companies Act. Requirements of this regulation is also applicable to them. They are required to report a lot of things with respect to this particular regulation. And if you are not aware about this, how we can say that the financial statement are in compliance with the financial reporting framework? Or let's say, for example, if management discloses this, how you will audit this? Till the time you don't have an understanding of what these terms and terminologies are. For example, as we discussed, Tier 1 capital, we are yet to go on the exposure of the assets and rest of the parts, but this is just a start we are talking about. Okay, so for example, this Tier 1 capital, if you do not know what is the requirement of the Tier 1 capital, if you do not know how to calculate Tier 1 capital, you will not be able to audit this particular percentage number. That's why it's important for us to understand these terms, to understand this particular terminologies and how to calculate that. See, amount raised by issue of perpetual debt instrument. Here we have a zero. But if this was an amount, then again, how much to be required to be taken, whether management has disclosed appropriately or not, all these things as an auditor, we should be aware about. Okay. So that is just an example. We will again go back and we will again, go and perform a deep dive into the reporting part. But first, we will understand the requirements of the regulation. Now we will understand the requirements of a regulation rather than doing a deep dive into the reporting part. Let's go back to the scale-based regulation. Scale-based regulations primarily, as I said, governs the NBFC. So it says that NBFC, whose principal business as defined in 45 IC, 45 IF of RBI Act, okay, is required to get registered under 45 IA of the RBI Act. Now, the term principal business is not defined anywhere. If I go back to 45A of the Act, 45I of the Act, definition. Okay. Now, here, if you see what it says, that carrying on the business of financial institution referred in C and includes the business of non-banking financial company referred in F. Okay. Now, when we went through and we saw the financial institution for accepting loan, all those stuff. And when we saw non-banking financial, we saw that, okay, F means a financial institution, which is a company, non-banking company. Now, this is very important part. This term, the term principal business, receiving deposit or lending in any manner, receiving deposit or lending in any manner. Now, the term principal business is not defined anywhere. What is principal business? It is not defined anywhere, this particular term of principal business. So there is a notification by RBI which defines term principal business. Okay, which defines the term principal business. Now, what principal business means? That notification talks about a rule which is 50-50, which is even also given in the scale based regulation. The term principal business is defined in this regulation, which talks about if the NBFC, if a company has financial assets more than 50% netted off by its intangible assets, and income from financial asset is more than 50% of its gross income, in that case, that company satisfies the requirement of the principal business test. So the term principal business says that 50-50 rule. 50% financial assets and income from those financial assets more than 50% of the gross income. Okay, that's your principal business rule, which is defined in the notification which was issued by RBI. Okay, now why we are reading or looking about the principal business? Because in order to get a registration, principal business is required to be met. This criteria, 50-50 criteria, is required to be met. You cannot say that, okay, my principal business is not of NBFC and still I'm going for a registration of an NBFC. No. So this principal business test is compulsory to classify or to meet the requirement of NBFC. Now, what are the financial assets? Very good question. So I received a question: what are the financial assets and what is the financial income from that financial asset mean? See, when we talk about financial assets, it is the same term that we use in the accounting standards. It's the same term which is used in the Companies Act also. So if a particular definition like financial asset basically over here is not appropriately defined, but you can refer the financial asset which is there in the Companies Act also. Okay. So the term financial asset is a term which is also there in the Companies Act or is in the accounting standards. So that is the definition we have to borrow from the Companies Act or from the accounting standard for the term financial assets. And the income from that financial assets more than 50%. Okay. Now, once you satisfy this criteria of principal business, then in that case, you are required to first of all obtain a certificate of registration, and then you are required to maintain the net own funds as specified by the RBI. So in order to carry out the business of the NBFC, first meet the 50-50 criteria, apply for the registration, and meet the requirements of net own funds. Okay, so apply for the registration, meet the criteria, and net own funds. Now, regulation specifies what are the requirements of the net own funds. What is the requirement of the net own funds? So there is a glide path given for the net own funds. That is that for basically NBFC ICC, NBFC MFI, NBFC Factor, the net own funds by March 2025 was 5 CR, 7 CR, and 7 CR. And by March 31st, 2027, it has to be increased by 10 CR. So gradually they started from 255, gradually now came to 577, and gradually they will go to the 10 CR. Later on, the net own funds for the NBFC, IFC, MFI, NBFT factor has to be reached till 10 CR. So NBFC, all these three categories have to meet the requirement of net own funds of 10 CR. But if there is a NBFC P2P, NBFC AA, NBFC not availing public funds, the net own funds for them shall be 2 CR. And NBFC IFC, NBFC IDF, or the NOF for them shall be 300 crores. So ICC, MSI, MFI factor 10, P2P AA or other NBFCs not availing public funds, not having any customer interface, 2 CR, IFC, IDF shall be 300 crores. These are the requirements of the net own funds. Clear? So this is a requirement of net own funds, and this is as per the, remember we discussed 45 IA clause B of subsection 1 as provided by the bank in official gazette in notification. This is the part where they have notified such other amounts. See, this is 45 IA 1B, such other amounts not exceeding 100 crores. But this such other amounts is coming over here in your scale based regulation. 40B, 1 and 45 IA. This is the net own funds that each and every NBFC is required to maintain. Clear? Any doubt? Any doubt? So, yeah, so there is a question that, sir, 300 crore is higher than the 100 crore. Then how it has been increased? Because in the act itself, there is a point. Provided that the bank may notify different amounts of net own funds for different category of NBFCs. This is the point where they can specify something different for a different category. This is general, like not exceeding 100 crores. But this provision overrides this 100 crores. So that's why you can see 300 crores also. Any doubt? Okay. Now, again, this is the level of net own funds. The question comes is that if this is the level of net own funds, from when we are required to meet the requirement of the net own funds? Let's say, for example, if this net own funds are there, then are we required to meet the are we required to maintain the net own funds from the day one, or are we required to maintain it from some other date? Okay. So from when we are required to meet the requirement of this net own funds? See, when it comes to the net own funds, there are two things. One, it is required to be maintained within a given time period. The time period is maybe, for like, basically given from the day of registration. Okay. So when you apply for the registration, you are required to meet that requirement of the net own funds. And if during any financial year, if your requirement or if your total amount of net own funds decreases the given limit, you may be ineligible to continue the certificate of registration. So the condition is there is that to maintain the certificate of registration, you have to maintain the net own funds. And if at any point in time, if you do not maintain this net own funds requirement, your certificate of registration can be cancelled. An auditor has to report on every year, like, on 31st of March, every year, whether this net own funds requirement were maintained or not. So reporting part, we will come to that. We will see, okay, what is whether like they were like what how they are required to report as an auditor, what auditor is required to report. But before that, we will go and we will see requirements which are with respect to uh, other things with respect to your assets, your provisions, which are known as a prudential norms. Apart from the net owned funds, once we understand this is the requirement of the net owned funds, now we need to understand the requirement of prudential norms. Okay. So these are the prudential norms or prudential regulations. These regulations, these norms, okay, what they are kind of the requirements, additional requirements apart from the net owned funds, which NBFC is required to comply to. For example, leverage ratio. For example, tier one capital. For example, provisions. So these all requirements are required to be maintained. Not only the net owned funds, but these requirements also. So once we will understand what are these requirements, then we will go and we will see the reporting part, because reporting is done on these multiple levels: leverage ratio, tier one, provision, your tier two capital if required, percentages, risk, weighted asset ratios. A lot of things are there. Okay. So let's understand the prudential regulations. Now, we are talking about prudential regulations which are applicable to the BL, base layer. This is for the base layer. Now, you will see, sir, where it is written. This is because the section that we were referring to, remember in start, that was for the base layer. I will show you the prudential regulations for the middle layer. See, these are the regulations, section 3, applicable to the middle layer. Okay. What it says that in addition to the regulatory instructions applicable to the base layer specified in section 2, these are also applicable to middle layer. So base layer requirements are already applicable to the middle layer. But in addition to that, this is something additional which is applicable to the middle layer. And if you start, you will get a prudential regulations. Means base layer requirement applicable. But above that, this is the additional requirement which is applicable to the middle layer. Similarly, you have further requirements for the different categories. For example, this is for top layer. So these are the higher requirements. Means whatever we have discussed till now in the middle layer, upper layer, base layer, that is applicable. But these additional requirements are applicable for the top layer. See, prudential regulations. So specific directions. Now these are the specific directions. Either it could be a microfinance, it could be a different category. So category wise, different regulations are being provided. I'll show you the upper layer. Sorry. So this was middle layer, and taking time. Middle. Yeah, this is upper layer. So in the upper layer also, it will say that in addition to the middle layer specified in section 3. So in middle layer, you already have a base layer. So applicable to the base layer, applicable to the middle layer, these are also applicable to the upper layer. In addition to that. Okay. And again, you will have a prudential regulations. You have all other requirements and all of things. So when we will discuss the base layer, that is applicable to all the NBFCs. Till that time, any specific requirement is not provided in the middle layer or upper layer. And there are scenarios where a specific requirement is provided in the middle layer or upper layer. And we will discuss those specific requirements. Okay. So first, leverage ratio. Now, leverage ratio is means that total outside liability divided by own funds. Okay. Leverage ratio is total outside liability divided by own funds. And that has to be maintained at 7. It shall not be more than 7. Maximum it can go up to 7 at any point in time in a particular year. So leverage ratio, except for MFI, ML, and above, okay, like MFI, middle layer or upper layer, top layer, except for them, this is the exception. You are not required to exceed the level of 7. It has to be lower than the 7 at any point in time. Okay. So the formula is total outside liability divided by own funds. Now the question, I have received a question that are we required to remember these ratios for the exam? Answer is yes. These are the specific requirements with respect to the NBFCs, which are required to be reported by the auditor. So we are referring to those requirements which are relevant from the auditor's point of view. Leverage ratio, Tier 1 capital, NOF, calculation of net own funds, base layer classification, all these things, whatever we are discussing, is applicable from the auditor's point of view only. Okay.
Yes, sir. Which means the leverage ratio, the own fund is 100 crores means that's a liability, that loan or something else, it can be 700 crores, not more than 700 crores.
No, see, again, now it is talking about 7. Okay.
See, I am talking, sir, I am talking about, say, example, own fund is 100 crore. See, outside liability can be
cannot be more than 700 crores. Yes.
That's what I'm saying. So
yes,
to understanding, see, I'm practically applying so that it can be retained more.
Yes.
Yeah. See, actually, this particular chapter, this session is more calculative and more provisions are involved. It needs more attention towards that.
Yeah, totally. Yes.
Yeah, compared to other chapters.
Yes. But remember one thing, there are 2 different terms which are specified from time to time. One is a net own funds, one is a own funds. So whenever we are talking about net own funds, it is the NOF, it is discussed separately. So here we were talking about, like when we discussed, we are talking about net own funds. The term is net own funds. The formula we saw in the act. But here we are talking about own funds. This is different than net own funds.
Yes, sir. That own fund will not subtract that investment in shares and the investment in bonds in the post company. That is only the difference between that.
Correct. So based on the formula, remember we said like, okay, there is a line in between and this one till here, till this particular Y amount, it was own funds. Below that, if you do the adjustment, you will get a net own funds. So we are now talking about only own funds for the leverage ratio. Okay. Now coming to the Tier 1 capital requirement. Tier 1 capital. What it says that if NBFC is involved into lending of gold jewelry, lending against gold jewelry, okay, that means 50% of more of their financial assets is of that particular nature. Loan comprises against gold jewelry. In that case, the Tier 1 capital shall be at 12% of the aggregated risk-weighted assets of on balance sheet and of risk-adjusted value of off balance sheet items. Now, this is, I'll come to that. But this is something, two new terms we are looking into. One, aggregated risk weighted assets of on balance sheet items and risk adjusted value of off balance sheet items. These are the two values that we calculate based on the given ratios. Now, ratios are also given. We will come to that. But as of now, remember the risk, the tier one capital level is 12% for NBFCs involved into the gold jewelry. If NBFC is involved into the gold jewelry, tier one capital is 12%. Any doubt? Any doubt?
Sir, less than 50% of their finance asset.
Less than, sorry.
If such loan is less than 50% of their finance asset, then also or then what is the percentage of
In that
capital?
case, yeah, see, this is a scenario where tier one capital has been prescribed for the primarily lending against the gold jewelry. If that is not the case, that means it is not a company engaged in the lending for the gold jewelry. Okay. That means it's a other category of NBFCs. And for the other category of NBFCs, there are other requirements. We will go to that in some time. But as of now, this is only for the primarily engaged in the lending against gold jewelry. If there is a separate other category of the NBFC, there are other sections also that we will see into.
No, sir. This NBFC lending against only gold jewelry,
Uh,
but this loan is less than 50% of financial asset.
so no. When your loan is more than, like the loan, such loans lending against gold jewelry are more than 50%, then only I will be able to say it is primarily engaged in lending against gold jewelry. Otherwise, I cannot say that it is primarily. So the term primarily engaged in lending against gold jewelry, that means your loans should be more than 50% of this particular category.
Okay, sir.
So such loans means lending against gold jewelry loans. Such loans should be more than of 50% of your financial assets. Then only I can say that primarily you are engaged into the business of lending against gold jewelry. Otherwise, you cannot classify under this. Clear?
Yes, sir. Clear.
Okay. Now, that is for one of a particular category that we were talking about, tier one capital. Now, there are other different kind of NBFCs based on the functions that we have seen. So to them, their respective regulations are also applicable. And, from time to time, RBI specifies different kind of limits for different kind of NBFCs. Yes, Samen.
Sir, could you please give one example, the comparative example, gold jewelry business loan comprising 50% or more on their financial asset and the other NPSC, so that if you give that a differentiate, then we will understand
No,
easily.
differentiate on what basis? Like,
On 12 percentage, the tier one capital of 12 percentage of aggregate risk weighted asset of the opposite risk weighted asset, and that we will learn later. That's not a matter. But in this particular point, I wanted to know what it means exactly as compared to the other business of NBFC.
yes, we will. So now, see, as we discussed, like, this is some requirements with respect to a particular NBFC. Now, when we will go to the ML part also, let me show you ML part, like middle layer one, we will see same kind of requirements over there. So, see, now this is prudential regulations for ML. For middle layer. Over there, we have a requirement of minimum capital ratio, which is consisting of tier 1 and tier 2, which shall not be less than 15% of aggregated risk weighted assets and risk adjusted value of off-balance sheet items. And tier 1 capital at any point in time shall not be less than 10%. Now, I can give you more examples of the comparatives, but you will not be able to understand the comparative reason because till that time I have not taken through the term, this specific term is aggregated risk weighted assets and risk adjusted value of off balance sheet items. Okay. So different categories have a different ratio, different requirements that we need to understand. But what we need to understand is that how to calculate them along with what this means. Then only we will be able to understand what is 15%, what is 10%, 12%, why it is, like how it can be calculated in that scenario.
Okay, sir. Got it, sir. Once you go through the overview of it, then we can
Yeah.
go for the specific item. Then we
Yes.
can easily correlate.
So at
Okay,
the
sir,
end,
fine.
see, when we will now there are multiple items involved. It is not simple something, one particular tier one capital or something. There are lot many things where we have to do a comparative analysis. Otherwise, what will happen is you will not be able to understand that particular topic. For example, provisions. For example, we will see with respect to the investments, some portion of incomes. So over there, we will do a detailed comparative analysis to understand the difference between the base layer and the middle layer, where middle layer goes different.
Yes, sir. Please carry on. We will follow it.
Okay. So basically, this was tier one capital requirement for the lending against gold jewelry. This is specific requirement. Okay. But to understand these kind of requirements of tier capital, tier 1 capital, tier 2 capital, we have seen the formula, how to calculate the tier 1 capital. Okay. But here the percentage is not given directly. For example, when we discuss this tier 1 capital, I know the formula, how to calculate the tier 1 capital. This is the formula which is given to me. Own funds minus this, that we discuss in detail. Let's say the outcome of this entire exercise of this particular formula. Okay, example I'm talking about. For example, the after doing the entire exercise, the tier 1 capital amount came to, let's say, hypothetical example, 150 crores. Fine. Now, this has to be compared with something. In case of gold one, we saw 12% of weighted assets. Sorry. So 12% of aggregate risk weighted assets of on balance sheet items. I have to compare something. I have to compare that number with some, another number to say that, okay, it is meeting the requirement or not. So this 150 should be, more than the 12% in case of gold. But let's say in other cases, more than 10% of this aggregate risk weighted assets, okay, of on balance sheet item. Now, what is this? Percentage level is fine. But what is this aggregate risk weighted assets? That we have to understand. So basically what has happened is these risk weighted assets, okay, are defined in the regulation itself, scale based regulations. Over there, you are given a table, basically, ratio wise table for each of the balance sheet items. Now, what is that ratio? That ratio is a risk level which is assigned to each of the asset category. I'll show you, which is there in the paragraph 84 of this particular regulation. Just a minute. Okay. So this is the weighted risk assets on balance sheet items. This table is a very important one. Why? Because it assigns a percentage weight to each of the balance sheet item in order to calculate the risk aggregate of weighted risk assets. Okay, means how much asset can be a risky. For example, bonds of public sector banks. So risk rating is given as 20% weightage. So what I need to do is here to calculate this, I need to multiply each asset item by the relevant risk weights to arrive the risk adjusted value of the assets. This is the risk rate. I need to apply the percentage, this percentage, 20% to the value of the asset, and then total out all the asset values that I have received. That means, let's say in my books, I have cash, I have this bonds, I have other assets. Let's say, for example, the ratio given is 0, 20 percentage, 0 percentage, and let's say 70 percentage, or let's say 80 percentage. Okay. Now the value is, let's say 100, 200, 400. So I have to apply these percentage, 0 into 100, it will be 0. 20 into 200, 40. Okay. 80 into 400, it will be somewhere around 320.
Yeah, 320.
Yeah. So it gives me 360. Now this 360 is the aggregate of risk, adjusted assets. Okay. So this risk, weighted risk adjusted asset, this 360. Now I need to apply, let's say for example, I say 10% of this, 10%. Now I have to apply 10%, I will get 36. This 36 I have to compare with this tier 1 capital. Yes, Ayush.
Sir, actually, I was getting confused. So, this is the total amount of risky assets. Like we have cash 0%. So, we are saying that we have 0% risk in cash.
No, no.
Is it working like that?
Yes. So we are assigning basically the risk weight to a particular asset.
Okay, sir. So, what I'm thinking actually, like this number is we have 360. So, this is the number of the total risky asset. This is the risk part of that asset. So, we are just carving out the part of risk related to that asset and totaling them.
Yes.
Okay, sir. Okay, got it. Thank you, sir.
Now some might say why we have a 0 for the cash. There is no risk, then why we have a 0 in that?
Sir, actually, that's why I was confused that if we are having 0 in cash, so that simply means that we are carving out the risk out of that asset. So we cannot carve out any risk in cash. That's why it's 0.
Absolutely, yes. So there is no risk in the cash. That's why we are saying there is no risky portion in the cash. Now, what is the basically need for the minimum capital? This tier 1 capital says that whatever risk have, at least you should have a percentage of that as your capital. So whatever risk you have in your balance sheet, apply percentage to that risk, and that much amount you should have a minimum capital with you. When I say there is no risk in the cash, means you are not required to have any additional capital in front of that particular asset. That's why the weight is assigned 0.
Yes, sir. Exactly. In business valuation also we study. See, actually the risk will be there in the asset side only.
Yes.
That risk how we are going to mitigate against the capital,
Yes.
which
So
means, yeah, which means that the risk will be borne by only the equity holders, not by the debtors. Debt never share there is no risk in it, which means here the 360 lakhs or crore, which means this amount is involved the risk. This risk, who is going to bear that? That the own equity. That is
so
what
to
the
mid-
tire is that
yeah.
to mitigate this risk 360, out of which at least 10% should be there, or 15% to be there, or 12% to be there. Like that, they are giving the guidance.
Yes, absolutely. So to cover that risk, at least some amount should be covered from the capital, and that's where we need to calculate this risk weighted risk assets based on the given percentage. So for each of the item, there is a percentage given. Fixed deposits, 100%. Okay. Shares of
Why,
all
sir?
companies,
Sir,
100%.
my basic fixed deposit in the bank, your house, or it is 100% risk is there actually.
Because these are fixed deposits.
Okay.
So you actually see again what is the scenario is fixed deposit. That means you have already invested in somewhere else. That amount is not with you. At some places it is beyond more than 100%. For example, credit card receivables. The risk which is assigned is more than 125%.
Okay, sir. Got
So
it, sir. No problem. The okay thing is that if it is a finance sector, the government company means they will give the full value. We can anyway get it. Since it is a
So they are
fair,
saying that is required to be. So whatever fixed deposits, shares, and investment you are doing, that is required to be covered by at least your 100% risk is required to be covered in those assets, and some portion will be covered by the capital.
okay, fine, sir. I wanted to understand the fundamental reason, the source reason why they are providing that risk weightage. Okay, fine, sir. Thank you. I got it now.
So similarly, you have different percentages assigned to all different kind of assets. For example, all assets covering PPP 50%, stock on hire 100, loans and advances fully secured. If it is fully secured, basically there is no risk. So that's why zero. Loans to staff zero
Sir,
because it's not considered.
sir, yeah, one doubt. Loans to stop if the loan is given now, the next day if the employee is resigned or left the company, the risk will be high, no?
You will deduct it from FNF.
Okay, that's
You can
fine.
issue a recovery notice. A lot of things are there. So that's why it's
Yeah, yeah.
zero.
Okay. That is a legal proceeding is subsequent. But on the premium phase is, the thing is that there is a risk actually. I don't know why they given zero, but okay. Right, sir.
Yeah. So consumer credit exposure 125%, excluding housing loans, loans against gold jewelry. So if there's a consumer credit exposure, 125%, credit card receivable, 125%. And like this way, a lot of these percentages are given. Okay. Once you have these percentage, you apply, you will get a weighted risk assets total. You total out, you can get the number, you can apply the percentage. Now there is one more term. Basically, I'm not deep dive into that particular category also, but there is called an off balance sheet items. Off balance sheet items are kind of, you can say, contingent liabilities. Okay, these are the items which are not there in the balance sheet. These are the guarantees, underwritings, and all those things. Those are also required to be considered, and there is a CCF factor which is required to be multiplied to get the number. But as of now, I will just show you. We will not go into much deep dive into that. So this is non-market related off-balance sheet items. The way we have risk level for that, we have a credit conversion factor over here, CCF, that you need to determine, that you need to multiply to get the amount. So guarantees, underwriting, partly paid shares, rediscounted, all those things which are, kind of in the nature of contingent, not necessary, but yeah, commitments. So all those things are covered under the off balance sheet item, which are not there on the balance sheets. You need to consider these also for the purpose of your calculation of tier 1 or tier 2 capital. But we will not go into the calculation part. This is for your understanding. Okay. How this weighted risk assets is calculated.
Sir, how to remember this percentage in altogether?
See,
Sir,
these percentages basically, if I say, are kind of very important. Uh, just think of, there are two categories in your study material also. Okay, if I show you this one on page 14.95 93, you have this table given. Okay. Now, remember one thing. Think of a risk point of view. What is the risk involved? There are 2 to 3 different categories of percentages. Either it is 100, either it is 0, either it is 125. 125 is assigned to only these two categories. That's it. There is no any other 125. Apart from that, either it is 100 or 0. So you just need to see with whether it's a risk-free or risk-driven. If it is risk-free, fine, you can apply to 0. If it is risk-driven, you can apply to 100. And there are certain categories where there is 20, like this one, state government claims, or this one, bonds of public sector. These are the two categories where you have a 20. So pretty much predictable, if you can say, the categories are and the weights.
yes, sir. Yes, sir. Now I understand. So the 0 and 20, 50 and 125. These are the items if you keep remembering. Others are 100%.
Yes.
Like it is easy to keep it in memory. Okay, sir. Fine.
So there are not many different percentages. Major is 100 and 0. There are two categories where you have a 20 and 125. Two categories. And there is one category, there is only 50. Okay, which is one that category? This one. PPE, triple P, public private partnerships. Okay, over there you have a 50. Otherwise, you don't have anywhere 50. Consumer credit card, both CC. Okay, this is 125. If it is CC, it is 125. That is consumer or credit card. Consumer credit card receivables. CC 125.
Sir, what is the consumer credit exposure means, sir?
Huh?
Okay. What is consumer
Yeah,
credit?
retail loans.
Oh, okay.
Retail loans, excluding housing loans, education loans, vehicle loans, but whatever personal loans, if I talk about personal loans, whatever personal loans have been given and as a receivable standing in your balance sheet, that's the consumer credit exposure. So triple P 50, double C 125, 125, and then bonds 20, bonds of public sector, PSU bonds. Bonds, PSU 20. Again, this one, state government guarantee claims, which have not remained in default. Same. Over it was PSU, now it is state government. Okay. Again, it's we have a claims of state government, which is 20. And if it is a central government, it is 0. Central
Sir,
government, 0.
sir, what is mean by here the 90 days in the state government?
This is the part where we are talking about default. Default for a period of more than 90 days.
Oh, if it is less than 90 days, okay, no issues.
Ah. So these are where there has been which have not been defaulted.
Okay, which means if it is less than 90 days, no default, then 0%.
No.
Hmm.
If it is not in default, so either not in default or default but less than 90 days, then 20%.
Okay.
No default or default less than 90%. No
And
default.
more than that is 100%.
Yeah. If more than 90 days, direct 100%.
Okay, fine, sir. Because this is very tricky actually.
Yeah.
Central government is straight away 0.
Okay.
Okay.
Central government, directly 0. Direct loan given to state government or state government securities, zero. This is guarantee claims. Guarantee claims are different. Remember that. I'm not talking about loan or securities of the central government, bonds of central government. I'm talking about guarantee claims. Guarantee claims are different. So if there is a guarantee claim and if there is a default in the guarantee claim, if it is less than 90, then 20, more than 90, then 100.
Okay, only with respect to guarantee only it is 20%. For others is okay, zero only. Okay.
Yeah. Now, then you take it fixed deposit, you take shares of all companies, you take stock hire, intercorporate loans, other secured loans, everything is 100%. Yeah, this is, again, the name suggests loans and advances fully secured against deposit sales. Means you already have a money against that loan. What is the risk? It should be zero. Staff, zero. Then bill purchase 100, others again 100, asset lease out 100, premises 100, furniture fixture 100, everything is 100. Yeah, advance tax. Now there is no risk in the tax because you have to pay the tax. TDS, you have to pay the TDS. So it's zero. Interest due on government securities means interest on government, central government securities, zero. Others again 100. So there are few items which name itself suggests that you have to apply the zero risk on that. But otherwise, everything if you see, it's either 100 or zero. There are two categories of 20, two categories of 125, one category of 50. That's it. This is PPP. 125 is CC. And these 22 are your state government claim and bond of PSU. That's it.
So
Entire table done.
so one more question: whether we need to the study material, whatever given is referring is enough, or whatever you shown in the provision of the original act, whether that we have to refer it, sir?
See, again, the point is whatever is given in your study material will be there, can be asked in the exam. Okay. But if there is a reference given for a particular section or particular provision, a question can be asked on that. So that's why you need to refer to all the provisions and sections which are given in the study material appropriately.
Okay. Here they given the note for students. Students may refer detailed call guidance given in the appendix.
This one. This one, note, or just below also over here. So it can be asked, yeah. Clear?
Right, sir.
So now, till now, what we have understood is, we have understood tier 1 capital, we have understood tier 2 capital, we have understood the requirement of this table, why this table is there, what is the use of this table. Okay. So tier 1 capital, tier 2 capital, then you need to check whether the tier 1 or tier 2 capital is meeting the requirement. Requirement is required to be calculated. Requirement is not given directly in your regulation. You have to calculate what is requirement. And then on the basis of that, you need to determine whether tier 1 capital or tier 2 capital is within the given limits or not. Clear? Any doubt? So that was the calculation of tier 1 capital, tier 2 capital. If there is a numerical question in the exam, this is how it is required to be considered and solved. Okay. Accounting standards. Again, this particular regulation also specifies which accounting standards will be applicable to an NBFC. Now, you already know we have a Schedule 3. Which division?
Division 1.
Division 1? No. Which division is applicable with respect to Schedule 3 for NBFC?
Division 2 is ours. Division 3, sir.
Yes, Division 3 is applicable with respect to the NBFCs. There is a specific division, Division 3. Yes, Neha, very good.
Division 1 is not yet notified, I believe.
Division 1 is, sorry?
For NBSC, Division 3 is applicable. Division 1 is, I think, is not yet notified.
No, no. Division 1 is for the companies to whom accounting standard is applicable. Division 2, NDS. Division 3, NBFC.
Okay, right. See, we are concentrating only on Ind AS, not looking at AS. AS
Yeah.
is for Division 1. Thank you. Yeah.
Yeah. Division 1, AS. Division 2, NDS. Division 3, NBFC. So for NBFCs, Division 3 will be applicable and the NDS is applicable. Okay. Now, one is that application of the NDS. That is there. There are other also requirement, disclosure requirement, which are also applicable. But apart from there is a specific accounting requirement. Okay, there is a specific accounting requirement. NDS is required to be followed, fine, but there is a specific accounting requirement which is given in the regulation itself, which overrides the NDS. This kind of overrides the NDS. Means if these accounting requirements says that you are not required to recognize the revenue, means you are not required to recognize the revenue, irrespective of whatever accounting standards say.
Yes, sir. These are the guidance notes: accounting for investment, accounting for derivatives, accounting for CFS. There is a guidance notes also is provided in this respect.
Yes. So we need to go through those requirements and we will see those requirements because these are the very important one. Okay. And these requirements basically very important with respect to the income recognition. These income recognition requirements are part of the prudential regulations, prudential norms. And we have to make sure that, when we are doing the audit, these requirements are met by the companies or NBFCs. Okay. Now, if you see this particular requirement, income recognition requirement, what they say that income, including interest, discount, hire charges, lease rental, or any other charges or NPA, shall only be recognized when it is actually realized. Okay, when it is actually realized. Now, in order to understand this specific line only, I need to understand one important term over here. That is NPA. I need to understand what is NPA. Non-performing assets. Asset becoming non-performing. This part. Before I deep dive into the income recognition, I have to understand the classification of assets with respect to the performance standards. Okay. Now, can anyone tell me what is NPA? If you have already understood or gone through, so what is NPA?
See, NPA is a non-performing assets when the account is overdue for the more than particular period of time. Say, example, more than 90 days,
Hmm.
like that. It will be classified as standard assets, substandard assets, loss asset. The classification will be differed based on that overdues.
Yes, very good. So these are the classification of assets based on whether they are overdue or not. Okay. This classification basically is given into the four categories. One is the standard asset.
Standard, substandard, doubtful, loss asset.
Yeah. Standard asset. Then comes a substandard asset. Then comes doubtful asset. and then comes your loss asset. Now, what is the difference between standard, substandard, doubtful, and loss?
For loss is
Standard asset,
yeah, loss is 100% provision to be done. That is for sure.
that is provision.
Provision.
Yes. But classification is first important.
Yes, sir.
Classification is very, very important. Now, first we will understand classification from the point of view of base layer. Okay. Standard asset, that means there is no default, nothing. You can understand as of now, standard asset means no default. No default. Okay. There is no default on any of the asset. That's a standard asset. Now coming to the substandard asset. Substandard asset is which is classified as the NPA for a period not exceeding 18 months. Once I classify a asset substandard for the first 18 months, that will remain substandard. So, if a standard asset is classified as an NPA, for the first 18 months, it will remain substandard asset. NPA less than 18 months. Now, another question comes is when it becomes an NPA, when I'm required to calculate if it's an NPA or it's not an NPA. So there are NPA norms which are given when I can classify a particular asset as an NPA. Now there is a small, I would say, point to remember with respect to the NPA classification. NPA classification changes by year. So if it is 31st March 24, the NPA classification is when it becomes overdue for more than 150 days. If I'm talking about March 31, 2025, more than 120 days. If I'm talking about March 26, it becomes 90 days. That means if I'm standing on 31st March 25, if a asset has become overdue for more than 120 days, it is overdue for more than 120 days. It is NPA. But when I come to March 26, I will now say that whatever asset is overdue more than 90 days is an NPA. So there is a glide path for the NPA. Let's understand in the form of a timeline. So you guys will be, better able to realize how it works. And this particular timeline I'm talking about from March 26 perspective as of now. Okay, we can adjust it for the March 25.
Sir, only one comparative for banks. This is NBSC is now only they are providing greater than 90 days from 31st March 2026. For bank already 90 days is there, I believe, 3 months.
Yes, yes. So to bring the parity between the NBFC and the bank, this kind of glide path was introduced. A lot of provisions, you will see that when we are discussing the banks, audit of banks, you will see, oh, this is the same. What we have seen in the NBFC. This is on the similar lines, what we have seen in the NBFC. The purpose of scale-based regulations was one, to do the regulations or bring the regulations based on scale. Number two, align with the practices which are followed for the banks. Okay, so let's talk about the timeline. Let's say this is the day when it became overdue. Okay, a particular asset became overdue at day 0. Now I am standing, as I said, this is for the 31st March 26. I am standing on the 90th day from the day it became overdue. For this particular period, from here to here, asset is not NPA. Asset is not a NPA. Beyond this, asset is NPA, non-performing, basically. So till 90th day, I am saying it is not NPA. Beyond 90, it is NPA. Now, the first condition was with respect to substandard asset. If it is substandard for less than 18 months, I will say asset which is a NPA for less than 18 months, it will be a substandard. Let's say 18 months are getting over here. 18 months from which date? This is zero day of NPA. Or rather than zero, I'll say day one. This is day one of being NPA.
Sir, which means the first day and the 90th day, whether they inclusive or exclusive, sir?
90th day you can exclude because the term is more than 90 days. Okay. So first day of NPA after this 91st day over here. Okay. This will become first day of NPA. From here till 18 months, which is 90 days plus 18 months. Now, if you start from this day zero, it will become like more 3 months more. 18 plus 3 months more, if I talk about 21 months. Okay. So from first day of becoming NPA till 18 months, this asset is substandard. Substandard asset. From this day till this 18 months of NPA, this will fall under the category of substandard. Clear? So that is a substandard asset based on the NPA norms. Now, if that particular asset is kind of, more than 18 months, it will be counted as a doubtful asset. More than 18 months, it's a doubtful asset. Let's go back. From here beyond, I will say like instead of like here, I will say 1 year, 3 years. Okay. This entire period going over here, this is doubtful asset. After 18 months, the doubtful asset starts and this will be classified as a doubtful assets. And again, why I am classifying 1 year, 3 year? Because of the provision requirement. 1 year has a different provision requirement, 3 year has a different provision requirement. Clear? Any doubt till now? Any doubt?
No, sir, it's
Now,
clear, sir.
yeah. Now, the question is that like this is the glide path which is given for the base layer or the NPA norms which are given for the base layer. And this categorization of 18 months, this categorization of more than 18 months, less than 18 months is given for the base layer. Does it mean that it is also applicable for the middle layer? I'll come to your question Sanjay, for in some time on the 3 years or 1 year from the 18 months or onwards or not, when we will discuss the provision. Over there, we will discuss the provision point also. But as of now, we need to understand whether this classification is same for the middle layer also, or is it different? What do you think? This classification is same for the middle layer, or is it different for middle layer?
I think there will be a different in the standard and substandard level, I believe.
Okay. So for the middle layer, basically, when I talk about this classification changes a bit. So a middle layer, particularly for them, substandard means 12 months. So when I talk about middle layer, this is base layer. Blue is a base layer. But when I now talk about middle layer, there is NPA less than 12 months. That will be the classification of this substandard asset. Means if a particular asset is NPA for less than 12 months, it will be counted as a substandard asset. If a particular asset is NPA for more than 12 months, it will be counted as a doubtful asset. So base layer, NPA more than 12 months, middle layer, sorry, more than 18 months, my mistake. Middle layer, NPA greater than 12 months. Second question. Is there any change in the definition of middle layer? Oh, sorry, in the definition of NPA. Or it is 90 days only. For NPA, for middle layer, is there any change in the definition of days? So when I talk about
No,
NPA,
sir.
The basic level is same, I believe. That 90 days, 120, 150, whatever it discussed, it is still hold good.
okay. So base layer, we have a NPA overdue glide path. Middle layer, overdue for more than 90 days. Overdue for more than 90 days. Now, if you are standing as per the glide path, if you are standing in the base layer in March 25, then that will be 120 days. It will be different for middle layer. But if you are standing on March 26, the middle layer NPA criteria and the base layer NPA criteria are same, 90 days. That's why I took the example of March 26 because now this will be applicable for middle layer plus base layer. But yes, this 18 months now been changed to 12 months. So if it is middle layer, I have to somewhere find between 12 months. Over there, it will become substandard. Till that particular time, it will be substandard and rest, it will be loss asset. Oh, sorry, yeah, doubtful asset. My mistake. Doubtful asset.
Sir, here the glide path means that only for base level, that is 150, 120, or 90 days as appropriate. For
Yes.
middle level,
So
it's greater than 90 days only.
middle level, there is no glide path. It was from day one, it was same because whatever NBFCs were there for the middle layer, like which were clubbed into the middle layer, already the regulations of those NBFCs, whether you take it systematically important deposit accepting or systematically important not deposit accepting, or other NBFCs, they were having 90 days. But the NBFCs which were clubbed into the base layer, for example, non-systematically important, non-deposit accepting, earlier classification, they were having the NPA norms of 180 days. From 180, they brought to 150 in 24. In 25, they brought to 120. In 26, now it is 90 to align with everything. So
For
when
upper and top layer.
this upper and top layer, see, I will not, go to the upper and top layer. I'll tell you the reason why. Upper and top layer, when I'm talking about upper layer, is nothing but the top 10 NBFCs. Top 10 NBFCs, upper layer. They are calculated on the base of risk scoring. Okay. And top layer is usually has to remain idle. It is the only NBFC which is more riskier. Those NBFCs will be taken into the top layer category. Okay.
The
Now,
systematic risk.
hmm,
Systematic risk, what we talk about.
yes. So now, if you see the regulations of these NBFCs, they are more specific from the risk point of view rather than the asset point of view. But when it comes to the classification of assets and classification of all these loss assets and classification of NPA, it remains most probably same. There is no change in that. So whenever now we will discuss, we will only compare between the base layer and the middle layer. Reason because upper layer has a classification from the point of view of risk, from the point of view of that, okay, they are the top 10, so they need to maintain more capital. They are more disclosure requirements compared to when you say, middle layer or base layer. So any which ways, the requirement of middle layer are already applicable to the top layer. Sorry, upper layer. And top layer would be one such NBFC which is coming into that category, which has a lot of reporting requirements and the compliance requirement apart from this categorization. Clear? Any doubt? Any doubt?
Sir, one doubt. In the upper layer, the category of selection will be top 10 eligible NBSC in the terms of their asset size, which means from the base level and the middle level. And both they
Middle
will
level,
consider.
not base level. Because if it is a base level and the asset size is so high, it will first go to the middle and then from there it will go to that.
Okay, because that base layer is less than 1,000 crore only will be there.
Yes. If it is more than 1,000 crore any which ways, it will fall into the middle layer. So directly from base to upper layer, it cannot be there.
Yeah, yeah. From middle to it will jump to upper layer, only top 10.
Yes.
Okay, sir. Okay, sir.
Now, a question may come that, sir, what is till 90 days? What we will do till 90 days? Like, okay, after 90 days, it is becoming NPA and, all these things and requirements are coming into the picture. Is there anything before 90 days? Any classification before 90 days from the date it becomes overdue? So, these particular category of accounts which are becoming NPA or overdue basically, okay, like not becoming NPA but overdue. So I'm talking about special category now. Overdue, but not NPA.
Approaching NPA.
Yeah, approaching NPA. Overdue, but not NPA. They are classified into three categories: SMA 0, SMA 1, and SMA 2. Now, what is this? SMA stands for Special Mention Account. Okay, special mention account. Because there is a default, it has to be special mention account. So for first 30 days, up to 30 days, it will be SMA 0, 30 to 60, SMA 1, 60 to 90, SMA 2, and beyond 90, beyond 90,
That is a substandard asset, NPA.
NPA. Very good. Beyond 90, it will become NPA. It will no longer be a SMA. Now, what is the use of this SMA category? We are not going to apply any provision or anything on this SMA. This is only for reporting purpose. This classification is only for reporting purpose.
I think for SMA 1 and SMA 2 needs more follow-up to regularize the account.
Yes. So this is more for the reporting purpose. This is nothing has to do with the provision part. So don't worry. There will be no provisions and everything required for this kind of classification. Only the standard, substandard, doubtful, and the loss will require provisions. Any doubt till now, whatever we have discussed?
So standard asset is equal to before overdue.
Yes, kind of, yes. You can say standard asset means it is before overdue, or you can say it has not become substandard.
Or sir, after overdue but before NPA. Which classification of assets?
After overdue, before NPA.
Before NP, huh? 90
Generally,
days.
it is, see, again, in those categories, those are special mention. As I said, they are not into standard, they are the special mention accounts. I do
Okay,
not
sir.
classify them into standard. They specifically lie into special mention accounts because there is a default already.
Sir, which means once the 90 days is over, then only it will be classified as a standard asset.
Substandard, yes.
Standard.
No. Once the 90 days limit has crossed, it has become the NPA.
Which
Now,
means,
once it becomes an NPA, it comes under the category of substandard.
okay, then the 0 to 90 days will be the standard category.
Neither standard, because if there is a default, it cannot be in standard. So usually this standard category which is there is the category where there is no default. That's why this SMA category was brought into, where if there is a default but less than 90 days, you bring it into this SMA category.
Okay, can we say like this? If the SMA 0 category will fall under standard asset?
Kind of. So these are
I-
so see again, standard asset usually means no default. Usually means no default.
No
That's a
overdue.
standard asset. Now, when I say default, or when I say there is some default has happened, okay, or this category is like, it is falling under SMA 010, 012. That means it is not standard, but it is also not a substandard. It is somewhere between the standard and substandard.
Sir, then I need one clarity on this. SMA 0, SMA 1, I need one clarity. Then it can be clarified, the standard as well. See, the thing is that loan is taken. The EMI is due on 31st, say example this month, 30th November is there. See, from 1st November to 30th November 2025, in which category you will fit, whether it will fit in SMA or SMA 0 will come from 1st November, December to 31st December.
Okay, when it was due for payment?
Due for payment is 30th November 2025.
Yeah. If it is 30th November, till 30th November, there is no requirement of payment. It will be standard.
Okay. Then only the SMA will be classified from 1st December to 31st December if the amount is not paid.
Correct. Because that's why the moment it becomes overdue, it will come into the category of SMA. It will come out from the standard.
Okay, okay. Now it's very clear, sir. What is standard, what is SMA? It's very clear now. Thank you.
Yes. So that's why I said overdue, but not NPA. And
Okay,
this is
okay.
only for the reporting purpose. For the
Right.
provision purpose, I will count still them as in standard only. For reporting purpose, there is a SMA 012 classification. That's why this is very important. Only for reporting, not for calculation of provision.
Right, sir. Got it.
Hmm.
Okay, okay. In my case, my example, if the 1st December starting means after the November, it will be non-delinquent. Before that, it's a delinquent account.
Yes.
Okay.
Any doubt on whatever we have discussed today with respect to the NBFC? Any doubt?
Just yeah, we are building our basic structure. It's need a one round of revision at least immediately.
It will require. See, the purpose of this session was first to introduce to the NBFC regulation and to make you understand some key terms. Because now, let's say when we are discussing NPA, we are discussing report. See, when we are discussing reporting requirements, auditor is required to report NPA. If you do not understand NPA, how will you report? So for that, first we need to understand few key terms that are relevant from the reporting's point of view. Once you understood that particular part, now we can go and jump to the reporting part. So our target is that we have to understand the reporting, and for that, these few terms are required to be understood.
Yes, sir. Now it's very clear because it is a money involved and the public money involved. There is more rules and regulations are involved. Banks and NBSC.
Okay. So any doubt? Any doubt till now? Whatever we have discussed in NBFC. Okay. If no doubt, what I want from you guys, see, again, this is very important that I'm saying. If you want to excel in this particular chapter, please make sure you do this. These tables, this is something we have already discussed, the layer system, everything. Now, what I want from your side is go through the study material. If you're not going through, go through this entire study material, read it. Because in the next session, what we will do is we will further proceed to the relevant topics which are there. For example, we will discuss about income recognition in detail, doubtful assets, NPA, all those things in much more detail. We will discuss on the provisional requirements. We will discuss on the audit procedures. We will discuss on the reporting requirements. There are other reporting requirements that we will discuss. For example, classification of frauds, audit checklist. A lot of things are that we are required to discuss in the next session. But for that, this RBI direction compliance reporting, a lot of things we will discuss. But for that, you have to read this chapter so that when I'm discussing the reporting requirement in the next session, this auditor's duty part specifically, you should be aware what I'm discussing. At least you should have a basic idea of that. Okay, I have read this somewhere. We are discussing this part from this study material.
Okay, sir. Sure, sir. I will go through and I will come back.
Okay. So this is you must do. And if you have any doubts, you can ask now or in the next session also. But do not keep your doubts with yourself. How much silly it is doesn't make a difference. Ask it. Because this chapter, if you have understood clearly, it's not that complex. Just the part is we need to understand this particular chapter with laws and regulations point of view.
Okay,
Okay.
sir. I have one doubt on Caro. Probably we will discuss on next class.
So on the
That-
Caro reporting part, yes, I will take up the Caro reporting clause also, the clause which is specifically related to the NBFC.
Okay, sir.
Okay.
During
Okay
during
then.
that time,
Hmm.
during that time, I will ask my question. I need one clarity. Probably I will ask that time. Yeah. Okay.
Sure, sure. Okay then. If no further doubts, then thank you guys. Thank you for participating in today's session. I will see you in the next.
Thank you, sir. Good night, sir.
Thank you. Good night. Yes.